Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Sailpoint Inc. Annual Report. Sailpoint Inc. provides a range of identity security solutions to various industries worldwide. At the core of its offerings are two primary solutions, Identity Security Cloud and Identity IQ. The former is a cloud-based solution that enables organizations to discover, manage, and secure all enterprise identities, including data and cloud infrastructure. On the other hand, Identity IQ is a customer-hosted identity security solution. In addition to these flagship products, Sailpoint also offers its Sailpoint platform, which unifies identity, data, and security intelligence in real time. This comprehensive platform empowers organizations to establish robust security postures and achieve regulatory compliance by automating policies and controlling access decisions. Sailpoint's solutions cater to diverse industries, including financial services, media, energy and utilities, technology, life sciences, healthcare, government agencies, and public universities. By providing a unified identity management system, Sailpoint enables organizations to streamline business processes, improve security posture, and gain deeper insights into their identities and access decisions. Sailpoint Inc. market capitalization of $7 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Sailpoint Inc. holds a significant advantage in their industry. Sailpoint Inc. trades at a lower price-to-book ratio of 1.01 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 175% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be categorized into several key areas. On the growth side, subscription revenue, expansion into new geographic regions, and strategic acquisitions are common drivers. For instance, companies like those in the software and technology sector have seen significant growth through investments in additional products and capabilities. Similarly, security and cybersecurity firms have benefited from strategic acquisitions. On the other hand, revenue decline is often driven by factors such as a decrease in perpetual license sales, provision for credit losses, and write-offs. Industry-specific drivers also play a crucial role, with companies in the healthcare and medical devices sector experiencing growth through strategic acquisitions like Imprivata. Geographic-specific drivers are also significant, with regions like EMEA and rest of the world showing substantial revenue growth. In conclusion, understanding these primary drivers is essential for businesses to make informed decisions about their revenue strategies. By identifying areas of growth and decline, companies can develop targeted plans to mitigate risks and capitalize on opportunities. The net income and profit margins of the company underwent significant changes between 2024, 2025, and 2026. Initially, net income decreased in 2025 due to increased competition, technological advancements, market consolidation, and higher debt service obligations. This decline was also attributed to lower profit margins caused by SaaS subscriptions, price reductions, reduced revenue, and gross margin compression. However, the company's fortunes reversed in 2026 as net income increased compared to 2025. The adjusted operating margin improved from 15% in 2025 to 18% in 2026, indicating a significant improvement in profitability. This turnaround can be attributed to various factors, including changes in market conditions and the company's ability to adapt to new challenges. The consistency of subscription gross profit margins is noteworthy, suggesting that this segment of the business remains stable despite external pressures. In contrast, services and other segments experienced decreased gross profit margins due to increased employee-related costs, accelerated equity-based awards, and lower revenue. Overall, the changes in net income and profit margins reflect the company's resilience and ability to navigate complex market conditions. The company's financial performance in 2026 is a notable achievement. One of the key indicators of this success is its ability to generate positive operating cash flow. According to the provided information, the company has successfully achieved this milestone, with a significant amount of net cash provided by operating activities. As stated on page 70 and confirmed on page 71, the company's GAAP net cash provided by operating activities for 2026 was $70,580,000. This is a clear indication that the company is generating more than enough cash from its core operations to cover its expenses and invest in growth initiatives. The consistency of this positive trend across multiple pages further reinforces the company's financial stability and resilience. Overall, the company's ability to generate positive operating cash flow in 2026 is a testament to its strong operational performance and effective management practices. This achievement will likely have a positive impact on the company's future prospects and provide a solid foundation for continued growth and success. The company's debt level has undergone significant changes in recent years. Initially, the current debt facility was a $250 million senior secured revolving credit facility with no outstanding borrowings or letters of credit. However, this changed with the 2025 credit agreement, which led to an increase in debt levels. Fortunately, term loans were repaid in full by March 3, 2025, resulting in a decrease in total liabilities from $1,804,215, 2025, to $751,330, 2026. Furthermore, the net carrying amount of term loans decreased from $1,024,467, 2025, to $0, 2026, indicating a substantial reduction in debt. The company's interest expenses have also undergone significant changes. Initially, interest expense was reported as a negative value of -$186,652, 2025. However, this changed with the 2026 financials, where interest expense decreased to -$24,635. This decrease is even more pronounced when comparing the 2 years, showing a reduction of $162 million, -87%, in interest expenses. The repayment of term loans and the decrease in long-term debt have also contributed to a significant decrease in interest expenses from $186.2 million, 2025, to $22.3 million, 2026. Overall, these changes indicate a substantial improvement in the company's financial health. The performance of various segments and regions can be gleaned from the extracted summaries. One region that stood out was the United States, which contributed 65% of revenue, indicating strong performance in this market. In contrast to other regions such as EMEA, Europe, Middle East, Africa, and rest of the world, their performance is not explicitly described as poor or well-performing. However, it's worth noting that these regions' performance may be implied by their lack of mention alongside the United States. The SaaS-based cloud solution, Identity Security Cloud, also demonstrated strong performance, with over 95% of new customers opting for a suite offering. This suggests that this particular product or service is in high demand and has been successful in attracting customers. The management of the company is optimistic about its outlook, citing continued revenue growth and positive cash flows from operations. The company plans to rely more on partners to help customers deploy software, which will lead to a decrease in professional services revenue as a percentage of total revenue. This shift towards subscription-based services is expected to drive increased subscription revenue. The management believes that the company's exposure to market risk with respect to its cash and cash equivalents is not material, but may enter into derivative or hedging transactions if necessary to manage its risk relating to fluctuations in foreign exchange rates. The company will continue to invest in personnel and software to support sales growth, and is evaluating the impact of upcoming accounting standards updates on its consolidated financial statements. Overall, the management strategy focuses on driving revenue growth through subscription-based services while maintaining positive cash flows from operations. This approach is expected to lead to long-term success for the company. The company's financial activities have been transparent and well documented. One notable aspect of their financial strategy is the decision to forego paying dividends to shareholders. This means that instead of distributing a portion of the company's profits as cash payments to investors, they have chosen not to do so. On the other hand, the company has engaged in share buybacks, which involves purchasing back its own shares from the market. This move can help boost the company's stock price by reducing the number of outstanding shares and increasing earnings per share for existing shareholders. That concludes the financial summary for Sailpoint Inc. Feel free to comment below, and I will be happy to answer them when possible.